Hi, this is SREY SOM, and in this presentation, I'm going to investigate 2024 in New Zealand prospects. This is my first investigation, which shows a New Zealand income statement forecast for 2024. So in 2024, in New Zealand anticipates set revenues of 6,948 million, with 5,600 million for cost of goods sold, which resulting in a gross profits of 1,348 million, and the operating expense are estimated at 903 million, which is the selling expense, and 694 million for administrative, which lead to an operating income of 445 million. For interest expense, it projects at 75 million, with tax expense at 112 million, resulting in a net income forecast of 258 million. Well, our balance sheet forecast for 2024 shows current assets of 2,435 million, include cash, account receivable, and inventory. For fixed assets of 2,779 million, which include PPE, totaling 5,214 million in assets. For current liabilities are estimated at 1,319 million, include account payable, short-term loans. And for long-term debts at 2,084 million. For the owner's equity is projects at 1,740 million, which result in total liability and equities of 5,214 million. You can find the calculation for both a New Zealand income statement forecast and balance sheet forecast for 2024 on page 7. So overall, a New Zealand financials forecast for 2024 expect sales to be driven by post-COVID-19 recoveries and increased flight capacity. The cost of goods sold is set at 80.6% of sale, while operating expense or projects at 13% of sale, broken down into 3% for selling expense and 10% for administrative expenses. For interest expense and tax expense are estimated based on current debt levels, interest rate, and historical tax rate. The first scenario, in New Zealand is gearing up for ambitious growth after the COVID-19 recovery. They're planning to expand their operation significantly by increasing flight capacity and exploring new markets. To fuel this expansion, they're seeking additional financing through loans and investments. The company intends to invest heavily in acquiring new aircraft and improving infrastructures to support their growth plans. This includes upgrading airport facility and making operation more efficient. They expect their sales revenue to exceed initial forecasts. To manage the increased operational costs, they may need to renegotiate contracts, optimize flight routes, and implement cost-cutting measures. Despite the upfront investments, Air New Zealand aims for sustainable growth and profitability in the long term. While facing challenges such as competitions and regulations, they're leveraging their financial resources and strategic capabilities to strengthen their positions in the aviation industry and create value for shareholders. For the second scenario, Air New Zealand is facing tough time due to economic uncertainties like global recessions or political instability. In response, the company is taking a cautious approach by focusing on cutting costs and improving operational efficiency. This includes reducing unnecessary spending, negotiating better deals with suppliers, and possibly reducing staff. Although these measures may initially lead to lower profits, they deem necessary to weather the storm and maintain resilience. However, uncertainties about market behaviors and public reactions pose ongoing challenges. Despite this obstacle, Scenario 2 highlights the importance of adaptability and prudent financial management to ensure Air New Zealand's strength during tough times. Service capacity. Air New Zealand is gearing up to serve more customers by significantly expanding its service capacity. This means they planning to offer more flights and more seats available for passengers, anticipating a 29% increase in available seat kilometer. Essentially, they getting ready to accommodate more travelers as demand grows. This boost in service capacity is expected to drive up the airline sales revenue. To make all this happen, Air New Zealand is investing in things like new planes and airport facility as outlined in their financial forecast. These investments are crucial for them to handle more passengers and flights. The external financing needs formula calculates the additional funding required to support projects' growth, considering changes in sales and retained earnings. In New Zealand forecasted total assets and liabilities suggest a potential need for external fundings to bridge the gap between asset and liability for expanding service capacity. The internal growth rate reflects the maximum expansion rate achievable using only internal resources, considering factors like return on assets and the retention ratios. This helps Air New Zealand access its capacity for growth without external financing, leverage existing assets and net income. The sustainable growth rate determines the pace of revenues expansions while remaining financial stability, incorporating return on equity and the retention ratio. In New Zealand balance sheet projections, including a mix of short-term and long-term debts, indicate a balanced approach to internal funds and external financings, ensuring sustainable growth and shareholder value over the long term. The second investigations in New Zealand strategic focus is on major investments like new aircraft and airport updates to drive growth and stay competitive. They carefully assess long-term financial impact through calculations like the cost of capital, which include equities and debt costs. Sustainability is also a priority, with plans to introduce electric planes and expand domestic network. Financial forecasts for 2024 anticipate strong sales revenues of 6,948 million, with significant investment in asset and liability. To fund their growth, they may need external financings as calculated through the external financing need formula. Air New Zealand balance internal resources and external financings through the internal growth rate and sustainable growth rate to achieve sustainable growth. For the third investigations, analyzing in New Zealand annual report reveal shift in their financial strategies and capital structures between 2022 and 2023. Impacting shareholder investments. In 2022, they maintained a balanced approach combining borrowings and equity financings. However, in 2023, there were noticeable changes, possibly indicating increase in borrowings for new projects or debt repayments. Shareholders raised concerns about the company's ability to manage debts and maintain profitability. Comparing specific figures in 2022, Air New Zealand had a net debt of 407 million and a gearing ratio of 16.4%, while in 2023 their net debt rose to 690 million with a gearing ratio of 25.6%. Despite higher debts, their credit rating improved signaling increased investor confidence in the company stability. This shift suggests a balance between risk and the investor confidence, potentially strengthening New Zealand's long-term financial health and benefiting shareholders. So thank you for listening to this presentations.